Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 297 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Good morning, Mark. You hanging in there with all this volatility?
Yeah, can't say it's fun to deal with, but we know that these types of situations happen over time, and this is the risk premium, as they call it, to be invested in the stock market and get the above, risk-free rate of return for your money over time.
Yeah,
right.
Well said.
So this isn't fun for us. It's not fun for clients. It's not fun for anybody, right?
Yeah.
So we'll get into a little bit of what's going on here in a bit. But before we get into this week's show, listeners, if you have been enjoying the Independent Advisors Podcast for a while now and want to take the next step in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com. Matt Jessup here with me offers a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at jessupwealthmanagement.com, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, please visit jessupwealthmanagement.com and book your call today. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts and as of the market close on April 23rd. S&P 500 index down 4.2% for the month and down 8.6% for the year. The Dow Jones Industrial Average down 5.7% for the month and down 6.9% for the year. The NASDAQ Composite Index down 3.4% for the month and down 13.5% for the year. The Russell 2000 Small Cap Index down 4.6% for the month and down 13.9% for the year. And finally, the Vanguard All World Ex United States ETF up 0.6% for April and up 6.3% for the year. 3-month Treasury rate at 4.33%, the 2-year Treasury rate at 3.81%, and the 10-year rate at 4.4%. So moving on to big headlines, current events from the past couple of weeks, Matt. As we've been saying, the tariff news just continues to change by the day. And, the 90-day tariff pause 2 weeks ago did provide some relief for investors, at least for the short term, which I think is good. But you continue just to hear contrasting information coming out. So, the administration came out and said that talks are ongoing with China and the tariff rates aren't going to be as high as initially were stated a couple weeks ago. And then you had China come out overnight and say, we haven't had any additional talks with the U.S. So we're in a state where I don't think can trust really anything that's coming out of anyone's mouths right
Feels
now.
like it at times.
So I think, you are trying to see the market price in what's really happening here. But as we've talked about in the past, a lot of damage has already been done to the markets. And as we always talk about, the market is forward looking. So I just question how much of this tariff impact is already baked into the markets. And I know that, I've been reading articles that, store shelves like in Walmart and Home Depot and Lowe's are going to start to empty out over the next couple of weeks.
Sure.
But if that is going to happen, it would not surprise me if stocks go up in the face of that, because that stuff might already be priced in at this point. And that's what we saw during COVID. One of my pieces is going to talk about, these just horrible earnings reports during COVID and stocks started to move higher because they were already down so much from their highs that information has already been baked in. So I think you are going to continue to see more and more negative economic data come out over the next several months, but with the caveat that you shouldn't be surprised if even when that happens, stocks start to recover.
I'm glad you're bringing this up because I think for a lot of individuals that don't do this every day, either on their own on the amateur side or on the professional side, run money for others, to see stocks go up in the face of bad news, whether it's economic or individual company news, tends to be very defeating for investors. And I think this goes back to the narrative that we've communicated pretty consistently in the podcast, which is make sure you are investing with a long-term time horizon in mind. And for the individuals that attempt to consistently time the market, it tends to be a very frustrating and losing battle at times.
Yeah.
Right.
Yeah. So, and like I said, I have some more on that here in a bit. But the first thing I had to talk about today was a post from Mike Zaccardi on X on April 12th. So Jenna will throw this up on the YouTube page. It'll also be in our show notes, but it was a post that said the S&P 500 retraced 50% of the October 2022 through February 2025 bull market. And it shows
substantial.
Yeah, it shows a chart of the S&P 500 from October of 2022 through year to date. So at this point through April 12th of this year. And if you're not viewing this on YouTube, what this is showing is that when Mike's saying the S&P 500 retraced 50% of that move up since October 22, virtually 50% of that move had been erased in the past several weeks, right?
Yeah, I mean, that's significant to put into context.
Right.
Just in literally 4 to 6 weeks, you've had a 2.5-year run, 50% of it gone.
Is gone, right? You have indices that are testing the I believe the 2022 highs, that we haven't seen since 2022. So I think when people look on the outside of that, they're like, oh my gosh, this is really bad, and there's a lot of money that's been lost. And yes, they're correct in that, but again, this is what happens in the market. You get these big, long, extended bull runs, like in this instance, from October 2022 through February of 2025. And then you have a 50% pullback or a 60% pullback of that move before markets start to bottom and recover and move higher. So this is something that we've seen play out in history again and again and again. And it sounds scary that 50% of that gain has been lost, but it's not permanently lost if you're not timing the market. And I think that's where people get into the trouble. They're like, oh, year to date, I've lost 20% or 15% or whatever that is. But if you look at it through the lens of when you started investing, this has probably happened a handful of times. So it does put into context, though, just how violent and volatile this move to the downside has been just since, late March, early April.
Great point. And my second point, I think we should talk about, and I will verbalize this for our traditional podcast listeners, is on this chart, it shows all of these smaller corrections along the way leading up to this February. You'll see a series of 5 to 10% corrections, and I can visually count very quickly 1, 2, 3, 4, 5, 6, 7-ish, 5 to 10% corrections along the way. And my reminder for investors again is, if you are seeking to sell your securities during one of those corrections or those times of uncertainty, the buyer is going to demand a discount, which is why you see these types of equity price sell-offs. We got to make it simplistic because it is that simple.
Yeah.
And so when you have a lot of uncertainty hit the market over the last couple of weeks, it's no surprise that if someone wants to sell, that buyer is going to want a discount. And so what happens when some certainty comes back to the market, or the market's forward looking, say 9 months down the road, it's when you start to see some bottoms.
Right. Yeah. And I think it's really, I'm glad you brought that up. It's important to remember that the stock market is based on supply and demand. It's what people are willing to pay for a specific index or a specific stock. People say that earnings drive stock prices, but I think earnings drive people to buy or sell stocks. They drive people's behavior, right? At the end of the day, it's just a market, and it's worth what someone is willing to buy or sell it for. And like you said, during times of uncertainty, people that are buying are like, hey, I need a 10% discount, than what you want to sell it at.
Yeah, to
right?
price this in. And what happens also is, why do you think conservative areas of the market tend to do better in times of uncertainty, right? So think of the traditional safe havens during a market correction, no matter what the reason is for the market correction. What does it tend to be? Historically, consumer staples, utility stocks, healthcare, the stuff that we use, quote unquote, no matter what.
You can't live without.
Yeah, and what tends to happen, and not to say it's going to happen this exact way over the next quarter or two, but let's just go under the assumption that the market starts to recover sooner rather than later. What wouldn't surprise me is to see people sell all the conservative safe havens and buy up all the beaten down stuff. It's just normally that rotation and kind of how it works. So I just want to throw it out there that don't be surprised all of a sudden if all the safe havens become the ATM. You got to get the cash to have it go back into the growth stocks. Wouldn't surprise me at all.
Right.
And whether that starts in a day or 3 months or 9 months, we don't know.
We don't know. Right. Second thing I had was a blog post from Michael Batnick on April 13th titled, "Who Are You Listening To?" So he says, everybody knows that stocks are a better long-term investment than cash or bonds, but everybody also knows the pain you must endure to earn those long-term returns is too much for some people to stomach. That's why it's called a risk premium. Investors demand compensation for being invested during the times when it feels like you want to vomit.
Wow, this is pretty timely that you picked this.
It is very timely.
Wow.
So,
Okay.
There are no guarantees when it comes to investing, but generally speaking, volatility spikes subside, and when investors who can hang on are rewarded. When volatility spikes subside, investors who can hang on are rewarded. Watching dollars vanish from your investment account week after week is painful and frightening. A few weeks ago, when futures were tanking and Bitcoin was crashing below 75,000, I saw someone whose opinion I value tweet something about how it was the end of the bull market and that prices for Bitcoin could fall to 10,000. And I think, Matt, as of right now, Bitcoin is around 94,000 still. So that this is yet to come to fruition.
Okay. Yeah, that's that. Yep.
And I'll admit, I thought about selling it all. My point has nothing to do with Bitcoin. Replace that with any person or any asset. If you're not careful about whose opinion you let enter your brain when emotions are heightened, it's easy to hit a button you will regret pushing when fear takes over the steering wheel. Remember, nobody can see the future. It doesn't matter what their credentials are, how much money they manage, how many followers they have, or how right they've been lately. You can't control where the market goes, but you can control how much noise you allow to pollute your brain. So I thought this is really good. And the height of this is when there's volatility and selling in the market. You have all of these experts on X or, writing their own blog posts telling you what exactly is going to happen in the future.
Yeah.
And I'm fine with that if people have data to back it up and it's not just a pure opinion. Like people like Ryan Dietrich, whose work that we quote a lot on this podcast, he says, hey, this is happening right now. When this has happened in the past, here are the forward returns for stocks.
In similar circumstances.
That stuff is
or the way the
fine,
market's acting, this data, yes.
The pure opinion pieces is where I think people get into trouble because they listen to somebody that they trust, and next thing you know, they make a decision that they regret 2 or 3 years down the road. And I'm sure you saw this a lot during 2007 and 2008 where people did permanent damage to their financial lives during that period of time.
I would say the toughest item coming out of the GFC, the Great Financial Crisis, is a very small handful of individuals had some really big gains by making some investments before the crash. And the problem that happened thereafter for a solid decade is anytime there was market weakness, who do you think was in the financial news media? That small handful of people. Heck, Mark, they even nicknamed a professor Dr. Doom. Okay? And what happened is there was people who would listen to that. Well, Mark nailed it in 07. So in fill in the blank, 2012, 2015, he must be right this time again.
The Michael Burry conversation, right? That we've talked about, ad nauseum, I think, on this podcast, that he was right with what happened in 07 and 08. So, people took his word as biblical in the future.
They did. And if you truly look at the performance, I'm not here to, throw rocks at the situation, but the fact is, how that gentleman trades is public knowledge because of SEC filings. And in retrospect, so far, generally speaking, the returns haven't been the best since the GFC.
Right. And I think there's been discrepancies about what he says and what his actual portfolio looks like.
There's another aspect to it. Yeah.
Right. So, so it's just, as hard as it is, because it's coming at you from a lot of different angles. I think the best
thing way of saying it.
You can do is shut off the noise as much as possible so it doesn't influence you to make a bad decision.
It was interesting. At the beginning of the year, I remember saying to clients, hey, I think that this is going to be a more volatile year.
Me too.
I remember saying that a lot. And I said, at the beginning of the year, I think it's going to be an okay year, but I think it's going to be a lot more volatile. And watch us get to the end of the year. I'm not saying this is going to happen, but let's just say the headline number, let's just say it's 8%. If someone went to bed on January 1st and woke up December 31st and just saw that their account was up 8, they have no idea the roller coaster that their portfolio went through.
Right. And I think a lot of people will be better off doing that. It's like, hey, check your balance on 12/31 and then don't check it again until 12/31 of the following year, because everything in between, there's so much that happens
especially
in between.
People with such a long-term time horizon. I had a gentleman reach out in his late 30s like, should I be changing my overall risk level? And I'm like, as long as your investment time horizon has not changed, which I don't think it has for you, then the answer is very quick and easy for me. It's a no.
Right. It's actually an opportunity for those type of people. So last thing I had is another blog post from Michael Batnick on April 9th titled, How Does the Stock Market Bottom?
Ooh.
And he wrote this, just to be clear, prior to the 90-day pause on tariffs.
Okay. So that's important to have
putting
context.
That out there.
Yep.
He says stocks are a discounting mechanism. They don't trade on what happened yesterday. They move on what they think will happen in the future. And right now, the future looks black as night. Panics create wonderful buying opportunities for investors with a strong stomach and a long-term horizon. I want to talk about how markets bottom. The biggest mistake I've seen investors make over the course of my career is selling into panic and thinking they're going to get in at lower prices once the dust settles. I'm here to tell you that's not how this game works. Either you'll buy in much higher or not at all.
True.
There are two paths stocks will follow once you've sold. Either they go lower and your greatest fears were confirmed. I knew it. I'm just going to wait until they fall a little bit more. They keep falling, but they go lower. The more they go lower, the less likely you are to buy. Or they go higher and you won't understand why, and you'll get angry at the stock market, which also we've seen played out. In 2022, the stock market bottomed a full year and a month before earnings did. I remember the market rallying on bad data, and people, myself included, had a hard time believing the rally was real. And I remembered individual stocks rallying on earnings reports that looked fake. In October of 2020, Carnival Cruise reported that revenue dropped from $6.53 billion during Q3 of 2019 to $31 million in Q3 of 2020, a crash of more than 99.5%.
Of top-line sales revenue.
The stock fell 2% that day. That's it. Why? because the stock had already plunged 89% from its high. The market doesn't wait for bad news to bottom.
No, that plunge was used accurately in that.
Yeah, and so fast forward to today, an example of that was, and again, this isn't a recommendation for or against Tesla, but Tesla reported earnings earlier in the week. A lot of companies have reported this way as well. Report was horrible. Sales down, guidance down, earnings down. And then the stock was up the next day, right? And some people, it's hard for them to wrap their heads around that and be like, wait, there's bad news, but then the stock is up. Well, what you probably haven't seen is Tesla's already down 50 or 60% from its all-time high. So again, just an example of how the market is forward-looking and it's not pricing in things that have already happened.
Yes, and again, not a recommendation for or against this next name, but I think you and I were talking about a home builder, D.R. Horton, a week ago.
Yeah.
Similar type of data feed, right? And the stock was up the next day. So it's interesting to kind of see those reactions, because that's a tall tale sign to someone like myself. Oof. That stock may have bottomed.
Well, and I think that's important for people to know. If you start to see this be a more and more consistent theme through earnings season, which we're in right now, I think Alphabet reports tonight, and I think a lot of the big tech companies are next week and the following week.
Correct.
If you start to see poor reports and earnings calls are bleak, people aren't optimistic, and stocks rally on that news, I think that is a good
sign
thing,
if
and
you're long the market.
Part of the recovery process for the market.
Well said.
So I would continue to expect bad earnings reports over the next couple of weeks, but if stocks can be flat or even slightly up during that time period, I think that's a very good sign.
I love the education that you and I do in this podcast. This is fun.
It's great.
This is
great.
fun.
So I hope I'm right.
No, but
I hope I'm right, because
see,
it's very possible for these companies to continue reporting poorly and the market continues to fall.
Again, our listeners and viewers are learning that, okay, if the earnings come out, they're negative and a stock drops, okay, it wasn't priced in. But at least we are providing some insights that, when a stock reports horrible earnings, lowers their outlook, and it's up, why can that be? We're providing that education and that situational awareness, which this is fun.
Yeah, it's great.
My first piece is about bearish sentiment being extreme. And the reason I like bringing this up consistently to our listeners and viewers is, historically, if somebody is bearish, their portfolio tends to reflect that sentiment. Not always the case, but it tends to. And when you see extreme readings on these data points, I tend to perk up, because it tends to be more of a contrarian type of data point for me, right? And let's just use the analogy. If everyone's doing the same thing in the market, whether selling or buying, and it hits extreme levels either way, you kind of want to take note, right? You talked about the market being driven by supply and demand, right? And if all of a sudden you hit a point of seller exhaustion, there's only one thing left at that point. You're going to have buyers coming back into the mold. And that's what you might be seeing in some of these earnings reports. This piece, it has to do with a weekly question that has gone out from the American Institute of Individual Investors, AAII. They started this survey back in the late 80s. It's a singular question every week. What is your investment stature? And you can only answer it one of three ways. That's it. You're bullish, bearish, or you're neutral. To have respondents, Mark, say they are bearish at a level of at least 50% or more of respondents is very, very rare. Okay? So Jenna will put up this chart for our YouTube viewers. This will be in our show notes. This chart goes back to the late 80s. And right now it is showing that when I did this, when I pointed out and prepped for this podcast, this data point was from April 17th. I saw the fresh one this morning. We are now technically 9 consecutive weeks. This will say 8.
That's funny. I was just pulling this up because I was like, I thought I saw something this morning that it's actually been to 9. So I think the survey is on a Wednesday.
Got
I
it.
think is what happens.
Got it. So yeah, I mean, let's just take us into context. Not even during COVID, 2008, the dot-com collapse, the 1990 bear market, you never had anything to this consistency and to the extremes of the sentiment surveys that we are seeing. I made an argument on the podcast, I don't know, I think it was like a month ago, utilizing the University of Michigan Consumer Sentiment Survey, that I think part of the reason for such the extreme viewpoints could be politically motivated, right? But at the end of the day, with bearish sentiment readings this extreme, they tend to be a contrarian indicator for me. And what I can't tell listeners and viewers is does that mean the market has bottomed already and we're recovering? Is there more pain to go and we're going to retest the lows that we experienced a couple of weeks ago? You and I both don't know that. But what I do know is when I start to see these such extreme indications, I can only assume that people's portfolios will posture that, and at a certain point, there's seller exhaustion.
Yeah, for sure. And I think, when people tend to make those portfolio moves, they're usually too late. So if you continue to see, this streak go from, 9 weeks to 12, 13, 14 weeks, where there's more bears than bulls, then I think ultimately when the market does recover, it's going to happen a lot quicker than people think. And a lot of people, unfortunately, are going to miss that move higher.
I agree, because you could have the market close one day and the next day it opens up at 9:30. I mean, heck, you talked about the returns month to date in a lot of these indices, 5, 6, 7% down. At any moment, we could end this month positive. That's just how wound this market is either way. My next kind of data point I always find interesting at these extreme times is insider buying or selling data. Barron's does a good job of showing and illustrating this data, and the date on this is April 21st. And what you're going to see is in this chart that Barron's had, it's indicating that the ratio of buyers to sellers, insiders of companies, right? They have inside information. They have windows that they can legally do this. It's showing a pretty dramatic amount of insider buying compared to selling. And what do you always say when it comes to this data? I know you kind of have a viewpoint when you see this.
Yeah, well, these corporate insiders have to report their transactions, right? So you see them buying stock and selling stock all the time. And what I like to say is, these people only buy stock for one reason, and that's to make money because they think their company's stock or other stocks are going higher. But they can sell for a multiple of reasons, right? If they need liquidity to buy a new house or send their kids to college or buy a new boat or buy a new car.
Or that individual or that company stock becomes a significant larger piece of their overall net worth.
Correct.
There's a lot of reasons, but there's only one reason why they buy.
Yeah, so it's hard to understand the reason why someone's selling, but when these people are buying that have usually a lot more information than people like me and you, it's something to pay attention to. And, you've seen, you saw this ratio, if you're watching this on YouTube, this chart turned very bullish that people, corporate insiders were buying pretty heavily in August of last year. And that's when we had that at the end of August, that big, correction in the market, and you saw insiders stepping in, and you're kind of seeing that same thing right now. Not to say that it's a perfect indicator, but if corporate insiders were selling stock hand over fist right now, I'd be a lot more concerned.
Well said. Now, this last piece I found pretty interesting. The underlying data is from Goldman Sachs. Goldman Sachs has a proprietary, what they call it, a policy uncertainty index. What I can't speak to is the formula at which this index is made up of, but I wanted to illustrate just some historical times What you're going to see on this chart, listeners and viewers, is Goldman has roughly about 10 data sets. And I'll just name off the points. September of 01, September of 06, August 2011, October 1992, January 2024, January 2013, March of 03, April 2020, February 09, March 2020. And what this will show is that what are the forward-looking returns for the S&P 500 1 year after a spike in their proprietary policy uncertainty index? Well, and I would argue that you want to talk about policy being uncertain, you're in the middle of it right now.
Right.
I mean, if you wanted to define policy uncertainty in the last 10 years, boom,
April 2025.
it is April of this year. The reason that I wanted to show this and talk about it to listeners and viewers, Mark, is it shows that more often than not, after these periods of uncertainty, the market prices that in, and then you tend to have certainty one way or another. And if you look historically, the market tends to recover. Now, there's a couple data sets where it was negative 1 year later. So let's talk about that first. So September of 01, September of 06, the forward-looking returns for the S&P were negative. So does this guarantee, just because we're going through policy uncertainty, that the market's going to be higher a year from now? It does not. But when you often look through the lens of history, when similar circumstances of uncertainty spike, the market discounts it, and then more data comes out, time heals that for one way or another, and the forward-looking returns in this chart aren't too shabby. Mm-hmm. So any thoughts or comments?
No, it's kind of a good consistent theme with what we've been talking about today, is that what people would think would happen in the stock market based on the news or the headlines going on around the world is the complete opposite, right? It's the George Costanza effect. It's,
Sure.
you know, there's a news headline that you think would influence something one way, and it actually does the complete opposite of that. And this is just another great example of that. It's just uncertainty, while in the near term is not fun to go through, it does provide a lot of opportunity in the long run. And I've likened this sell-off to March of 2020, since that was the last violent quick sell-off that we had. And look, after March of 2020, a year later, S&P 500 was up 63%, which during March of 2020, it seemed like the world was coming to an end.
Yeah, I mean, heck, we had a couple of days there. I still have the screenshots saved on my computer. You know, the S&P, I remember going home one day, the S&P was down 10.3% on one of those specific trading days. I mean, that is just massive, historic moves in the indices, let alone the individual names.
Yeah.
And then the next day it'd be up 8. I mean, it's just, and obviously we've experienced very similar bouts of volatility the last couple of months. I've aged the last couple of months.
Yeah, I think a lot of people have.
Yeah.
And it makes it harder, right? In today's day and age, with the technology that we have, and being able to see your account balances on your phone, and being bombarded with it on, when you're watching TV, and, if you're a subscriber to, news apps, getting, constant alerts throughout the day about what's going on, it doesn't make it any easier.
No.
I'm sure this stuff was easier 30 years ago. And I think that's part of the reason why these moves are more violent and more quick to the downside, is that people get information a lot more. I mean, heck, 30, 40 years ago, you had to wait to get home from work at night to watch the nightly news to figure out what happened in the stock market.
Or read the paper the next morning.
Right. So the economy was a lot slower moving, right, than it is now. And I think, that's why you see these larger swings. And I know you've talked about that for some time now, that you think we've kind of entered this new era of that these are what bear markets and corrections are going to look more like, rather than the slow, death by 1,000 cuts.
I agree 100%. I truly feel that volatility to the upside and downside is going to get magnified as the information flow becomes quicker and easier to obtain. We got to remember, at the end of the day, this is important for our listeners and viewers to remember, For the financial news media, there is only two guiding emotions. There's only two: fear and greed. That's it. And so when you are at the grips of fear, those headlines, they're getting more clicks. They're making more money. And in the opposite, when the market's really rallying, they're going to be on top of that too. Fear and greed is what drives the clicks.
Yeah, for sure. For sure. Well, anything else you want to share with listeners?
I think it's
before we
just
leave it out
earnings
for the week?
season, Mark. I think you might see some more volatility in individual names. You are starting to see overall market volatility, indexes and indicators come down some. I don't think we're out of the woods yet by any means, but I'll definitely continue to watch how some of these earnings come out, the policy narrative from the administration. I think the next couple of weeks are going to continue to be very, very eventful.
Yeah, I agree. If it's anything like it's been for the past several weeks, continue to expect more news, more headlines, and more noise. So we will get through this, which might take some time, as it always does. But we want to thank everyone for listening to episode 297 of the Independent Advisors Podcast, and we will be back with you next week.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.